Hello and welcome to the National Real Estate Post. We are here with our friend Barry Habib to open up 2018. Say hello to everybody, Barry.
Hey, everybody.
Thank you so much. Before we get started, two quick mentions. You know, we're in 2018. It might be time for a change in two directions. Okay, number one, if you happen to be a wholesale account executive and you're looking to make a change, Remen Wholesale is hiring experienced wholesale account executives. They're a great company, fantastic. They'd love to have a conversation with you. Just click the Remen banner you see on your right, or there's a link up above on Facebook to get a hold of them. And also, speaking of people hiring people, Movement Mortgage, they're always looking. It's 2018. If it's time for you to make a move, for whatever reason that might be, you'd like to have a confidential conversation with, quite frankly, one of the best mortgage originators in the country, just awesome company. Click on the Movement Mortgage banner you see on your right, or the link up above on Facebook, and you can get your new year and your new career off to a great start. What's thoughts on that, Barry?
It's a new year. You want nothing but the best for yourselves.
That's right. So with that, let's talk a little bit. I'll open us up. Over the holidays, we've seen rates kind of hedging up. You, of course, have been telling us this is going to happen, and it's been happening. But you and I were talking. You were talking about, hey, you know, the fact that the Feds aren't buying so much, aren't buying any mortgage bonds anymore, or have tailored that back. You kind of expected this to occur. What are we looking at today and going forward with respect to that? And then just with rates and housing in general for 2018, we're hoping to get your thoughts on 2018 going forward here.
So I think rates are a little bit higher in 2018. Not crazy, but a little bit. And, you know, some people say, well, the Fed's going to start hiking rates. You know, mortgage bonds tend to do okay with Fed rate hikes. But what the real problem here is the drainage of liquidity, not just in the United States, but from around the world. So you and I have talked about this in the past, how the Fed's reduction of its balance sheet, unwinding of its balance sheet, it's an enormous amount of mortgage bonds and treasuries on its balance sheet. So October of 2017, they started buying less mortgage bonds. Now, a lot of people say, well, wasn't QE over? Well, yeah, it was over. But when you refinance someone, you sell your home, you pay off that mortgage, or just the principal payments as part of your mortgage payments, that's an awful lot of money. And when the Fed gets that, instead of allowing what their holdings are to just naturally start to get a little bit smaller, they've been taking that money and reinvesting it in treasuries and mortgage bonds. That comes to the tune of did come to the tune of about $25 billion a month reinvested in mortgage bonds. They were number one buyer of mortgage-backed securities. So what they said was October 2017, we're going to start slowing that down. We're still going to buy, but we're not going to buy everything. We're going to buy everything minus $4 billion a month.
Okay.
So they bought a little bit less than what's happened to rates, Frank. They've gone up a little bit.
Right.
Now, we are in January. Happy 2018, everybody. We're in January. They said we're going to ratchet that a little bit more. So instead of buying everything except $4 billion, everything except $8 billion.
Wow.
Which probably, all else equal, and we said this when we talked about it initially, it's everything else equal, because there's a lot of things that affect interest rates. But if everything else were equal, this is definitely a headwind for the mortgage market as far as rates go. So now you can anticipate a little bit of upside pressure in rates, a little bit of downside pressure on prices. Now come April, they ratchet it again to where they'll increase that to $12 billion less. Then in July, $16 billion. And in October, finally going to stay at $20 billion. Now, while they're doing this, a couple of other things. They're also ratcheting down their reinvestment in treasuries. Instead of it being ratcheted in $4 billion quarter increments, that's $6 billion. Okay, so that's a lot of pressure on treasuries. At the same time, the European Central Bank is going to be cutting half of its QE. So that's going to be about $30 billion a month less that the European Central Bank is buying. So there's a lot less influence from the central bankers to buy up this paper. And you think about it, when people are buying, what does that do to the price? It keeps prices high, and as mortgage bond prices and treasury prices and other bond prices improve, it means you don't have to offer us higher rate. If people are out there wanting to buy your paper, I don't have to influence them to buy by offering a higher rate. I could sit back with a very low rate, but with a little less buying, you'd have to assume that there's some upside bias on rates. Now, remember we said all else equal. All else equal means that, do we get a lousy stock market move, which means money floods into the bond market and pushes yields a little bit lower, prices a little bit higher, or does the stock market continue on its? So it all depends on a lot of other factors influencing it too. But by and large, the gravitational pull is going to be higher for rates, lower for bond prices.
Yeah, this is definitely, it's like it's getting the economy and the market off the teat of the governments, be it ours and, like you said, in Europe as well, and letting them stand on their own, which is definitely putting pressure on the rates. Like you said, all things being equal, this alone would definitely put pressure on rates to rise in 2018 for sure.
And I think it wouldn't be a big surprise to see 3/8 to 0.5%. Now, I want to segue into housing here for a minute because I think housing still remains incredibly strong.
Okay.
But I don't think it's enough to cause a problem in housing.
Okay.
However, we know how sensitive refinances are, and I could tell you this, just look at 2017 as a model. When the spread of rates between 2017 and the specific period compared to 2016 at that same period a year earlier was higher in rates, you saw refinances really throttle back.
Sure.
And here's what we saw. About a 40 basis point rise in rates caused almost refinances being cut in half.
Yeah.
So I don't know if we'll see as much as a half of refinances gone in 2018 at some periods of time when rates are higher, but I definitely see them softer and slower in 2018 than they were in 2017, which was softer and slower than 2016. So bottom line here is you really have to focus on the purchase business. And thankfully, the purchase business will be strong, but not enough on its own to compensate for the lack of refinances. So you really have to be strong on purchases, and you really have to take market share in order to continue to grow your business.
What do you think about, so obviously your feeling is that housing is still going to be nice and strong going through 2018. What you mean by that is we're still going to see home values strong going forward. Is that what you're basically saying?
Yeah, my forecast, and listen, thank goodness we've had, our forecasts have been very, very good for quite a few years on housing, and my forecast for this year is that I think you'll probably be safe to say 4.5%. Of course, markets will vary, but overall across the country, about 4.5%. I think that we could see it in the range of 4.5 to maybe a little bit above 5% as well, if we were to give ourselves just a little bit of a range here. So on the low end, I'm seeing 4.5. Now, most of the forecasters are bringing their forecasts down from 2017, which was a really strong year. And the reasons for that are because the changes to the tax laws create a little bit less of an incentive compared to renting to purchase a home. So that's a negative. And then the other aspect is I think that rates will be a little higher, which will be a little bit of a headwind as well. So those two things don't derail the housing market, but they tame inflation, they tame appreciation a little bit, but it's still good. Look, let me put it to you this way. If you have a $500,000 home that you purchase and you just look at, 4.5% appreciation, you're still looking at about $22,500 appreciation in a period of time that's just a year, and if you were to continue to see that over time, it's incredible what it does, So.
Yeah. Awesome. Hey, let me ask you this real quick, and we'll try and get out of here. Still on the housing matters. I've been, reading a lot of reports and whatnot, and I guess new homes and new housing starts are on the rise. And in fact, they were predicting new housing starts were predicted to do pretty well going into 2018, which is certainly going to help a little bit as far as the inventory issue goes. And I know the lack of inventory is also helping to drive the values of homes and keep home values high. So we might get a little bit of easing if new home sales, kind of come around a little bit better. But I know this is just kind of off the cuff here, but do you foresee resale inventory coming back a little bit here in 2018 at all? Any thoughts on that? It might be too early to speculate this.
Well, we finished 2017 as far as some of the reports go. We'll still get some of the reports, let's say for December, but with real strong housing data. Extraordinarily low supply, very, very tight supply, and sales moving up much stronger than expectations. So the demand's definitely there. The supply is definitely tight. And, when we look at new home sales, we're not back in the levels of, 10, 11, 12 years ago, when it was ridiculous, when it was 2 million new homes a year. Today, it's been coming back quite a bit, but it's still about 1.2. Hopefully, maybe in 2018, we get 1.3 million homes on the market, but it's still dramatically lower than those crazy numbers where it was just too much coming to the market, too much supply. So we're definitely not going to be able to catch up that easily. And then on the other side, the demand will probably increase because household formations are more than likely going to resume. Unless you think people aren't going to get divorced anymore, I don't think that's happening.
Right.
Or because the other aspect of household formations is if you look at people that will be creating households, somebody that's living at home and needs to get their own place. So those situations would be dependent on what the birth rates were from 30 years ago or so, 33 years to be specific. And those birth rates kept going up, which means there'll be more and more of those people. Now, here's the one thing that's kind of a phenomenon that's occurring. Because things are expensive now, you're getting these double up households where people are saying, well, rather than create my own household, I'll take on a roommate or I'll room. So, but eventually that gets old, so all you'd be doing is delaying the formation of a household rather than saying it's not going to happen. So that to me just speaks of a delay, pent up demand, as opposed to, there's a real sea change in what's going on.
There you go. Barry Habib.
I really like the housing market still going forward for, we look at all the different areas in the country. I mean, it just looks so strong to me. I think it's really good years at least. And this would be a great time to buy. It's a good message to get out to your realtors as well.
So for all of our realtors and LOs, it's all about grabbing market share. Get out there and get it going.
Well, but that's the thing, Frank, is that we talked about market share. It's not just the apps that are coming to the marketplace. Amazon says they're going to get into the mortgage business. Amazon.
Yeah.
Okay? Think about that. So take a lesson from the stock industry. Before all these online trading platforms, ton of stockbrokers, they're all fat, making money, right? Then all these online trading platforms come out and their ranks get slashed.
Yeah.
They're still around today, and the ones that are around are making more money. What did they do differently? They decided to make it a career instead of a job and take it seriously. And they decided to be better than their competition by being smarter and creating so much more value. You need more than just being able to qualify somebody. You have to be smarter.
There you go. Barry Habib on 2018 rates and housing. Appreciate you being on the call or on the show today, Barry.
I love being here, bro. Good to talk to you always.
Always, man. Thanks.
Everybody,
so much.
wish you guys a happy new year and a healthy one for all of you. Got a lot of success in the year ahead.
All right. Thank you, Barry. And with you guys, do us a favor, leave us your comments down below. Do us a favor and share and forward this video. We appreciate that. And subscribe to the show if you're meeting us for the first time with that. We'll catch you all later here at the National Real Estate Post. See you later.